Hey YouTube, this is Zach with Achilles Financial, and today I'm going to be highlighting my favorite ETF. And what I have here on the screen is the Vanguard S&P 500 ETF, and they trade under the ticker symbol VOO or VOO. One of the reasons why I prefer them versus a ETF like SPY, which is another market fund, is going to be that expense ratio. So you can see here on the left-hand side that in order to handle all of the buying and selling and rebalancing of the account, that Vanguard is going to be charging me 0.03% or 3 basis points of that total investment. So that's something that you're going to see get charged based on your holding. Now, what I would also highlight is one of the key differences here versus SPY is that SPY currently has a higher rating or a higher expense ratio of nearly 3 times that at 0.09. Now, in the grand scheme of things, because these companies are because these investments are so similar, the return is going to be nearly identical. And you can see that here in the performance, where the SPY market return for 2022 is negative 8.07, where if I am going to go over to VOO, you can see that it is nearly the same performance at negative 8.07. So what I would highlight is you can see that the companies, or rather the ETFs, both continue to perform very, very well. And a large part of that is because they have so much exposure. So in a time period where we have a huge valuation tied to tech stocks, and you see some underperforming stocks such as the energy sector, we then see in a year like this where holdings such as Exxon or Chevron continue to buoy the overall fund. So overall, again, on a 5-year performance, it looks very good and very healthy with a more than 100% return on investment over that 5-year time horizon. Something that I would highlight is that this is a weighted indices. So if you look at the companies that make up this grouping, in terms of sectors, you can see that there are materials, consumer cyclicals, financial services, but some of the big components is going to be technology here down at the very bottom of your screen. They continue to perform very well, but I would highlight that we are trading currently at a very high price to sales ratio as well as a very high price to earnings ratio compared to what we've seen historically. Now, that being said, if we scroll down below, you can see the top 10 holdings in this group. It is still very largely driven by tech companies such as Nvidia, such as Google, Amazon, Microsoft, and Apple. So you've got these very high performers in terms of these large companies, very high growth rates. But in a year like this really showcases the power of index fund investing, where you can see the year-to-date return is negative across the board compared to having some of these companies such as Berkshire Hathaway, United Health Group, and Chevron, Exxon, some of the energy suppliers, which have continued to do very well, AbbVie being another one. And the other nice thing about something like this is they do have a dividend yield of 1.62%. So what that showcases, if you were going to be looking at the performance of the ETF, you are going to be getting those quarterly dividends. So you're going to see that get deposited in the account, or if you are running this and just casually having this continue to accrue, you do have the capability to turn on DRIP, which is dividend reinvestment program, and have that continue to buy more shares of VOO, and you just have it sit there in the account, and you can see that that dividend is much higher than the expense ratio, which means that you are going to continuously be earning more based on that dividend as long as none of those dividends change materially. But this is a more than 1% guaranteed return, and this is one of the reasons why I heavily encourage the use of index investing with a dividend and just having it sit there and not checking the market on a daily basis, and having a fund like this be a core component of your portfolio. One of the things that I would highlight is there is an excellent book entitled The Little Book of Common Sense Investing, and that is written by John Bogle, and he is the former CEO of the Vanguard Group. And what you are seeing on the screen is the Vanguard fund that he began, and it is highly showcasing the value and how rare it is for either a single stock or a single hedge fund manager to beat the S&P 500 over a long-term time period, One of the things that I love about this is, again, it tracks the S&P 500, continues to perform very, very well, and you don't have to look at it, and they pay a dividend. So this is one of my favorites, but keep in mind I'm just some guy on YouTube, and this should not be construed as financial advice. But if you find this content helpful, please leave a like and subscribe, as it helps the channel to grow. Thanks for watching. Talk to you later.